Good morning, everybody, and welcome to this Ulton tax webinar. This morning, we're going to be talking about a subject matter that many people are talking about at the moment, and that is the changes that were announced by the government in the last budget to capital gains tax, negative gearing, and the taxation of trusts. This has seen some of the most significant changes to taxation that we've seen for some time. So understandably, there are a lot of people out there that are concerned about this and how these particular changes may apply to their personal circumstances. My name is Daryl Corpe. I'm a partner at Ulton and head of the tax advisory division here, and I'm ably assisted this morning with Connor Silcox. Connor is Senior Tax Advisor with Ulton, working in very much within the area of taxation, including capital gains tax, negative gearing, and other matters. This morning, Connor's going to talk first on the changes to capital gains tax and negative gearing, and then I'll come in and talk about trusts. And how this new tax regime is going to apply in the future to trusts and the distribution of income that comes from trusts. Without anything further, Connor, I'll hand over to you, and you can tell us all about capital gains tax. But before we go there, you can see that disclaimer on the screen that obviously everybody's personal circumstances are different. I encourage you to seek advice on these particular matters, and the advice we're going to be giving this morning is just general advice, and how the legislation will work. It applies differently to everybody, so I encourage you to get advice on your personal circumstances. Connor, we'll kick off and talk about capital gains tax, negative gearing, and provide some clarity around that subject matter.
Thank you very much, Daryl. So today I'm talking to, as Daryl mentioned, capital gains tax and negative gearing, the changes that have come out of the budget. And we've seen some draft legislation come through in the form of a bill that's currently before the Senate. It was passed by the House of Representatives a couple of weeks back, and it is now before the Senate for debate and voting. Over the weekend, the Senate committee handed down its report in relation to these changes and approved or recommended that they be approved and voted on by the Senate. So these changes are coming very soon, and we have a lot of key dates in terms of when these things come about, which I'll talk to shortly. So the changes that have been introduced is that from 1 July 2027, we're going to have indexation replace the 50% CGT discount. There will also be a 30% minimum tax on those net capital gains on amounts earned and realised after 1 July 2027. What's important to recognise here is that we've got the capital gains tax regime, which taxes capital gains, and the government introduced indexation initially, then the 50% discount, and now we're reverting back to indexation again to compensate investors and taxpayers for inflation over time. So what we have here is the change of the compensation for the indexation is come about. But one very large change is that pre-CGT assets are now going to be taxed. So pre-CGT assets were assets that are acquired before the 20th of September 1985. As we're now in 2026, there's very few pre-CGT assets about. But what happened from 20th of September 1985 through to 1 July 2027 is that these pre-CGT assets, when they were disposed, there was no capital gains tax liability at all. So the change is that from 1 July 2027, growth from 1 July 27 onwards will be taxed. And the way they're going to do this is two methods. The asset can be valued as at the 30th of June 2027, or a formula can be used to determine what the value would be on the 30th of June 2027. And then that value will be indexed with inflation, and the sale price minus that indexed value will be the capital gain that will now be subject to capital gains tax. These same calculation methods, the valuation method and the apportionment method, will be used to determine to what extent the 50% discount or indexation will apply to assets that were acquired prior to the 30th of June 2027 and sold after the 30th of June 2027. Assets that are sold before 30 June 2027 will be subject completely to the 50% discount, just the same as any asset acquired after 1 July 2027 will be solely subject to indexation. There are carve-outs, as there always are with these changes, and the key carve-outs are that new housing, so new builds, will still be able to use the 50% discount, and those that are receiving welfare benefits as well as the age pension will be able to use these different concessions in different ways. The one in relation to welfare recipients is the 30% minimum tax. So the changes are that any gains realised and earned after 1 July 2027, tax at least 30% must be paid. However, those on welfare benefits will not pay that additional tax. Importantly, there is no changes for superannuation funds. The superannuation funds still receive the 1/3 discount available to them. So I just want to move forward onto a simple example. So we've got a asset that was acquired prior to 30 June 2027, in this case 1 July 2025, and sold the 30th of June 2029. So obviously post our 27 change date. So we've got one half of the ownership period that is going to be assessed using the 50% discount, and the other half will be assessed under the indexation regime. So we're required to use the transitional approach to work out to what extent we can use the 50% discount and to what extent our gain is going to be indexed. What is critical here is the valuation date. So the 30th of June 2027, and gaining that valuation. So there's two ways that valuation can be sought. You can see a valuer, get that valuation, and then put that in the drawer for when the asset is eventually sold. Or alternatively, we can use the ATO's approved method for determining what that valuation is going to be. These methods are very complex, and the ATO is to release calculators on this, but it does not resolve the complexity completely. In this set of circumstances where the asset was purchased for $1 million on 1 July 2025, has a valuation of $1.2 million the 30th of June 2027, and a sale price of $1.5 million on the 30th of June 2029, there are different tax outcomes depending on which valuation option is used. So the valuer valuing at $1.2 million at 30 June 27 results in these very specific set of circumstances in a worse outcome than the apportionment method under the formula. This is assuming, though, an indexation rate of 4.85%. And as these numbers move, the tax outcome changes dramatically. For instance, a higher valuation here, as at the 30th of June 2027, could result in a better tax outcome than that currently calculated under the apportionment formula there to the right. So negative gearing. There are no changes to negative gearing until 1 July 2027. Firstly, negative gearing is a term that's spoken about quite widely, but just so we all understand what we're talking about here, I'll go through it quickly. So negative gearing is where an asset is acquired and there is usually debt on that used to acquire the asset that results in interest costs and coupled with the other costs of owning, for instance, a residential rental property, exceeds the rental income that is earned from that property. This loss can currently be used to offset against other income and reduce tax payable. The changes that are going to come into effect existing residential rental properties, only affect existing residential properties purchased from 7:30 p.m. on budget night, the 12th of May 2026. So when I'm talking about existing there, I'm talking about properties, houses that are already built, and those already built properties acquired after budget night cannot result in that tax loss being offset against other income. Importantly, new builds are exempted from this, and so are other asset classes such as commercial property and investments in shares are exempted. Existing residential rental properties that are owned prior to budget night are grandfathered. So those taxpayers that do have those properties already in their portfolio and they are incurring these negative gearing losses, that is not going to be changed by this change of law. The losses from existing residential rental properties acquired after budget night are going to be quarantined. It should be noted, though, that these losses can be offset against other residential rental properties. So it's not looking at it on a property by property basis. It's looking at as an asset class, residential rental property. Those losses that are still left over after being applied against other rental income from other properties are effectively quarantined and used as capital losses that can then be used to offset future capital gains on the sale of residential rental properties. And just to reiterate, that's not a property by property basis. That is on the asset class. So if there's losses that are going to be quarantined in, say, the 2029 financial year and another property is sold in the 2030 financial year, that gain can be used to use up the losses out of the 2029 year on that particular property. Last week, we had some further updates from the government in what they plan on doing in relation to the small business CGT concessions. It's been a large concern by the public of the removal of the 50% discount and the taxation of specifically small business owners when they go to sell their property, because they don't have a large cost base as there might be for other asset classes. These changes increase the eligibility of those taxpayers that would be eligible for the small business CGT concessions, increasing the turnover limit from $2 million up to $10 million. So those taxpayers with businesses that have turnover up to $10 million can now access the 4 small business CGT concessions, which are the 15-year exemption, the 50% reduction, the retirement exemption, and the 2-year rollover. What's important, though, is that the small business CGT concessions worked in conjunction with the general 50% discount to provide small business owners and taxpayers the beneficial tax outcome. And this can be demonstrated by a simple example. So a taxpayer starts a business on 1 July 2027. They have share capital of $1. So that is their cost base. In 30 June 2030, they sell that business for $4 million. In that case, there is a capital gain of $4 million. And under the existing rules, that would be able to be reduced by the 50% general discount to bring the taxable income, the capital gain down to $2 million. Then a further 50% reduction under the small business CGT concessions could be applied to reduce the capital gain again down to $1 million. Then the retirement exemption could be used by a husband and wife that own the business, and the lifetime limit being $500,000, being that the whole $4 million capital gain would be wiped and there'll be no tax payable. Under this change, we do not get that 50% general discount at the start. So you start with the $4 million, you get the 50% reduction under the small business CGT regime to reduce it down to $2 million. And then if the husband and wife use their $500,000 allotment of the retirement exemption, it'd bring the capital gain down to $1 million. So there's still $1 million of taxable income that the taxpayers are going to have to pay tax on. So whilst the eligibility for the small business CGT concessions has been widened, the total benefit out of these changes, coupled with the changes to the 50% discount, will result in small business owners paying more tax. It's been announced there will be further carve-outs for CGT discount for innovative startup businesses. The details of that we're yet to see. And there are some small changes in relation to the interaction between the CGT minimum tax and charitable donations, as the commentators stated that it could reduce the amount of charitable donations made because of these CGT changes. And just to close out, there's some other changes that aren't CGT or negative gearing related I just want to talk to for a moment. There is now a $1,000 instant tax deduction against employment income. This was a measure that was discussed in the previous election, is now in the piece of legislation before Senate at the moment, and that will be moved into law. Another change is the loss carrybacks. This is very similar to the COVID measure, where losses are made in a future year, those losses could be used against a prior year where tax was paid to get a refund of that tax. There is also the introduction of a startup loss carryback provision, where whilst the company might or taxpayer might not have paid tax previously, but paid tax in the form of an employee's PAYG or FBT, that amount of tax can be refunded. And last of all, the instant tax deduction for the acquisition of depreciating assets by small businesses has been made permanent. Over the last several years, we've had different qualification criteria and different regimes, and now the government's going to make that permanent, which should give us some certainty in relation to our tax regime going forward. Thank you. I'll hand over to you, Daryl, to talk to us all about this tax on discretionary trusts.
Thanks, Connor. As part of this change to taxes announced by the Treasurer on budget night, what is the taxation on discretionary trust distributions. And this is going to see some of the most significant impacts on family groups and how they distribute income in the future. Unlike capital gains tax and negative gearing, which we have draft legislation for, we have no draft legislation for the taxation of discretionary trusts at this point in time. So all we know is what the Treasurer announced on budget night, and there is significant impact, as you will see in the various examples that we'll go through, and there'll be much conversation about this particular subject matter in the coming months and years. What's important to know is in the future, there will be a 30% minimum tax on trust distributions, which occur after 1 July 2028. So this taxation regime is not going to come in for a couple of years yet, but when it does, there will be some significant issues. In particular, distributions to corporate beneficiaries, which has been a feature of trust distributions in the past, in particular within family groups and how they accumulate wealth, will be significantly impacted by this regime. There are also some trusts which are exempt from the taxation of trust regime, and we'll go through those. The government announced on budget night that there would be some rollover relief, which would be announced within the next 12 months on how family groups could restructure so that they can minimise the impact of this particular tax. And I also wanted to mention briefly a very significant decision that's been handed down by the High Court in the last few days, which is the case of Bendel. Many of you have heard about that particular case, and I just wanted to go through the impacts of that case and how this taxation of trust regime interacts with that decision within Bendel. A very important decision, but now maybe not so important. So we'll talk about the detail. This particular tax is only impacts on discretionary trusts. Okay, so discretionary trust is one where the trustee has the discretion to distribute to the beneficiaries, which may be included in the beneficiary class within the trust. So typically that would be in a discretionary trust, that would be family members and usually any companies or trusts controlled by the family. Okay. The main feature of the tax is that the trustee will be assessed 30% on any income that the trust distributes to the trust beneficiaries. Okay, the beneficiaries will still be taxed on that trust income. However, the beneficiaries can claim a non-refundable tax credit equal to the amount that the trustee has paid, the 30% tax, on the distribution that has been made to that particular beneficiary. And corporate beneficiaries, and this is the main kicker, is that corporate beneficiaries, however, are not entitled to that non-refundable tax credit, which is going to significantly impact the way in which income will be distributed from discretionary trusts in the future. Now, the next slide provides a simple example. So this is a simple example as to how it works, so we can sort of get our head around the regime. If we take the example where we've got a discretionary trust that has $100 in trust income to distribute to, in this case, an individual beneficiary. Trust income is $100, and when the the trust distributes that to the beneficiary, in this case, the individual beneficiary, the trustee will be assessed 30%. That's the trustee tax. So the trustee pays 30% on its distribution of $100 to the individual. Now, from an individual, so we've got $30 being paid by the trust at that point. From the individual's point of view, that $100 is included in the individual's assessable income. And if we assume that our individual in this case is in the top marginal rate of tax, which is 47%, that individual will be assessed $47 on that trust income of 100. However, the individual is entitled to a tax credit of the $30 that the trustee paid on that distribution. So in this case, the individual will pay an additional $17 on that $100 worth of trust income that they received. And so the total amount of tax is 47%. So you might say, well, nothing much has changed. And the individual has paid top marginal rate on that extra $100 that they've got. Nothing's changed. And that's fine. For those that are in the top rate of tax, nothing has changed. Those that are distributions that are made to individuals that may be on pay no tax or have no other income and do not have earnings above the tax threshold, which is about $20,000, those particular taxpayers will be assessed $30 on that income. So in the past, where no tax was assessed, the government's now getting $30 from those low income earners. Seems in contrast to the words that they put in their budget papers. Just move on to a more complex, and we'll get these examples to get more and more complex as we go, but now we have a situation where a trust distributes to a company, not an uncommon situation. So same type of thing. We have a trust that has $100 in trust income, makes a distribution to a company. The trustee is assessed $30 on that distribution. That's the trustee tax. The bucket company, or the company that receives that trust distribution, now has $100 in trust income. Company pays a tax rate of 30%, so it will be assessed $30 on that trust income, but receives no tax credit. As you might remember, when I started here, or started on this particular subject, I said that companies do not get the advantage of the non-refundable tax credit. So company is not eligible for that. So an additional tax of $30 is paid at the company level. So we've got trustee tax paid of $30. We've got company tax paid of $30. So distributions to a company in that situation, there will be $60 tax paid, or 60%. The next diagram here is a fairly common structure for family groups, whereby there's a trade company that earns the profits from operating a business, and that trade co has a shareholder trust, and that shareholder trust receives dividends from TradeCo and distributes that dividend income to a separate company, and that separate company is used to accumulate assets for the benefit of the family, or lends those funds back to TradeCo to fund its business in some cases. But usually it's there for asset protection purposes, so that assets can be accumulated outside of the trade company operations, a secure environment. And typically that bucket company, the shares in that bucket company, are held by a shareholder trust, so that distributions can be made to family members at some stage in the future. So how is that particular structure, which I said is a fairly common structure, is going to be impacted by this new tax on trust regime? And what you'll see here, and I'll go through this in a minute, that income, once it was received by the family members, would have been taxed at a maximum of 47%. Now will be taxed by up to 70%. So a significant change in the amount of tax that would be paid by the family group by distributing income in this way and continuing to use that type of family structure to accumulate wealth. So I'll just briefly go through how this works. We've got a typical trade company that earns $100 in income. And assuming that the turnover of this company is less than 50 million, so a typical small business, it pays a company rate of tax of 25%. So we have a company that's paying 25%, $25 on $100. So we've got $75 left in after-tax income, which is then distributed by way of dividend to the shareholder company. The shareholder trust. The shareholders trust has $100 in trust income, which is the $75 dividend plus the franking credit. That $100 is then distributed to the bucket company, and the 30% trustee tax is paid on that distribution, but the trust gets the benefit of the franking credit that was attached to that dividend. So the additional tax that's paid by the trust at the trust level on that distribution is an extra $5. So at that point, we've got $30 in tax being paid. The bucket company receives the $100 worth of trust income, gets assessed $30, but doesn't receive the benefit of the refundable tax credit. So an additional $30 is paid there. When the bucket company ultimately distributes the income to family members, because remember the bucket company is there to accumulate assets for the future benefit of the family, the bucket company pays a dividend to the trust to be distributed to family members. And assuming the family members are in the highest tax bracket, this is the way it will work. The trust will have taxable income of $57, which is we now only have $40 left of the original dividend that came from the trade co, being paid as a dividend from the bucket company to the shareholder trust. So we got $57 of taxable income. The trustee will be assessed $17 on that distribution. So the trust will pay no tax at that point. The individual will have $57 in taxable income. It will be assessed at 47%, so $27. It will receive a non-refundable tax credit of the $17 that the trust number 2 paid, and so there'll be an extra $10 in tax paid there. So all up, $70 in tax will be paid on that first $100, whereas previously would have been assessed at 47%. And dare I say, you won't do that in the future. That will not be a viable, sustainable structure. And we'll talk about briefly in a minute how some restructures might occur to prevent income being taxed at those punitive rates. But first of all, what does this tax not apply to? What trusts are not going to be subject to this particular regime? Fixed trusts does not apply to, and mostly they're unit trusts, but not all unit trusts. Complying superannuation funds will not be subject to this tax regime. Deceased estates. So a deceased estate is a trust. So if I died and left all my assets to my executors, those executors hold those assets that I held before I died in trust for my estate beneficiary. So that is the type of trust that will not be subject to this regime. Special disability trusts will not be subject to this regime. Charitable trusts are also exempt, and prime production income is exempt. So that where we have a trust that carries on the business of prime production, let's say that carries on the cattle grazing business or grows crops, the income generated from those businesses and distributed by a discretionary trust will not be subject to the 30% tax. Testamentary trusts now will not be subject to this tax. You may remember on budget night, the Treasurer announced that testamentary trusts that existed prior to budget night were exempt, and those that existed or came into existence after budget night would be subject to the 30% tax. Therefore, if you died prior to the budget, you're okay. If you died after, you're not okay. So, but now, due to a fair bit of media and public pressure, the proposed legislation has now been amended to exclude testamentary trusts, subject to a limitation on the beneficiaries that can exist within those trusts. So, provided those testamentary trusts only include individuals and tax-exempt beneficiaries, those trusts will be exempt from the trustee tax regime. Without getting too complex, just wanted to talk briefly about potential restructures. Obviously, those family groups that have the types of structures that I previously spoke about are going to be impacted and are going to want to seek advice about how they can restructure to minimise the impact of this particular regime that's going to be imposed upon us after 1 July 2028. And quite obviously, you can see from that previous example that trusts will avoid making distribution to corporate beneficiaries. Distributions to corporate beneficiaries now are going to incur punitive rates of tax up to 70%. So what can you do to get to structure yourself out of that? In particular, where the trading company exists and there is a need to accumulate assets for the benefit of the family in a structure without having to pay top-up tax on or limit the amount of top-up tax that's going to be paid. There currently exists, without there being any further amendments to the rollover relief regime, various methods that can be used to restructure, and I've just got a couple of those on the screen there. What we call a 122A rollover, where property of a trust can be rolled into a company, and that's a fairly common rollover. Or we can have what we call a scrip for scrip rollover. In this particular example here, we have Tradeco, which is owned by a trust, and in the past, the shareholder trust of Tradeco distributed to a bucket company. Now we know we can't do that anymore unless you want to pay 70% in tax, and nobody wants to do that. So how do we resolve that particular issue? What we can do is insert a company between Tradeco and the shareholder trust, so that dividends get paid up out of Tradeco So they're out of the the risk environment, if you like, to the holding company, and that holding company can then be used to accumulate assets without any top-up tax being paid on the dividends that stream up from TradeCo to HoldCo. And in the future, dividends that are flowed out of HoldCo would go principally to family members to fund their lifestyle, rather than being then distributed to a corporate beneficiary. So that will be one of the mechanisms and I think that will be a popular mechanism that'll be used to restructure many family group shareholding that exists between trusts and the main trading entity. There'll be many other, I would expect, alternatives that'll be discussed with family groups as we go forward, but we'll have more clarity on what will be available when we receive at least the draft legislation on how this taxation of trusts will work, and the rollovers that will be available to family groups to restructure. But there are further issues that will need to be considered in these restructures, in particular stamp duty. Although there may be rollovers to minimise the impact of this taxation of trust regime, any restructure comes with the risk of duty. And in particular, where we have shares in companies, and those companies are what they call land rich, that is, that they hold significant amounts of real estate, that transfer of shares may be subject to state stamp duty. Now, we've heard nothing from the state government at this point in time as to whether they're going to provide any stamp rollover relief for stamp duty, but early days, so that may well still happen. We don't know, but the state government at the moment is obviously being coy about this, and I would imagine they'll be seeking compensation from the feds if that's what they do. Well, with any restructure, we need to consider family trust elections. I won't go into too much detail about that, but family trust elections enable trusts to stream fully franked dividends, and they also enable trusts to claim past losses, but they restrict trusts as to how they can distribute their income, and that is they can only distribute their income to members of the family group. So that's always a consideration when we're restructuring, and that would be discussed with at the time. And as we say here in the last point, any proposed relief is not yet law. We're waiting to see that legislation, but I suspect, as you can see, the changes to this legislation will be complex, and I expect that we won't see any proposed legislation for some months yet. That's all I wanted to say about the taxation of trusts. But I did want to mention very briefly a High Court decision that occurred in the last few days, which was Bendel. And Bendel, it was a decision that was being considered by the High Court and was much anticipated, in particular by those that had trusts, and those trusts distributed income to companies. Prior to this decision, and I'm sure those that were familiar with the distribution of trust income to companies would have known that where the trust distributed income to a company and did not pay that trust income to the company, then that particular distribution was subject to the Division 7A regime, which deemed that unpaid distribution alone and forced trusts and companies to enter into a loan agreement, and that loan had to be repaid over 7 years plus benchmark interest, or that distribution was deemed a dividend. Now, the High Court confirmed that in fact was not a loan, and that an unpaid distribution that was made by a trust to a company did not fit within the definition of a loan, and therefore not subject to Division 7A. However, before we start popping champagne corks about that, the sobering issue is that the ATO, through a what they call a PCG, which is like a ruling but not a ruling, said that irrespective of whether the fact that this was issued after their defeat in the full federal court, said that irrespective of whether they lose or not, they will consider that those unpaid distributions to a company subject to division to Section 100A. Now, what that means is this: that what Section 100A is about is where a trust makes a distribution to a beneficiary and doesn't pay that distribution, the ATO can deem that distribution was never, or the beneficiary was never intended to get the economic benefit of that distribution where it remains unpaid, and will assess that distribution to the trustee at a rate of 47%, unless that unpaid distribution is placed on a commercial loan arrangement. And a commercial loan arrangement, the ATO considers to be similar to that of a Division 7A loan. So we end up going back in a broad circle that this doesn't change much at all. So my advice to everybody since that decision is proceed with great caution. Don't necessarily think that from now on unpaid distributions made to a company by a trust will be free of the shackles of Division 7A. The tax office has made it very clear that that's not their view. And when you couple this particular decision in any case with the new regime that's been announced, you're never going to want to make a distribution from a trust to a company in any case. So to some extent, although the decision came with great fanfare, the impact now with the the tax of trust regime has taken away a fair bit of the excitement. No one's going to want to distribute to a company from a trust. Okay, I think that that really gets us to the end of this presentation. I hope that you've learnt something from it. I don't think there's any good news in any of this, either from a capital gain. I know there's no good news in this from a capital gains tax, negative gearing, and certainly from a taxation of trusts point of view. There will be a lot of discussions over the coming weeks, months, years on how we deal with this particular issue. As Connor set out from the beginning, we now have law. The House of Reps have passed capital gains tax negative gearing law. Still to go through the Senate, but the numbers are with the government. We've still got to see the legislation in relation to taxation of trusts and this rollover relief that they're going to provide to everyone. So more still to come. I imagine more of these webinars still to be made, more discussions with clients and accountants about their particular sets of circumstances. Now we've got time for questions, Connor.
Yes, we've got a good one here, Daryl. If holding company is not a base rate entity, wouldn't it be paying 30% tax and having the 25% credit from TradeCo, it pays the 5% difference? Now, I might just go back to the relevant slide quickly, and I think we're referring to this structure here and our potential restructure to the right-hand side of this screen.
Yeah, and in that particular case, the income flowing up to Holdco in the restructured example, that income would be base rate income, and so there would be no top-up tax at the Holdco level. In the previous structure, where we've got Tradeco paying up to shareholder trust and then shareholder trust distributing to a bucket company, in that situation, the dividend, if you like, flowing to bucket company loses its base rate entity character, and the bucket company pays the 5% top-up tax, as was pointed out by a listener. But in the modified restructure, there is no top-up tax, provided the only income, if you like, going to Holdco is the dividend flow from Tradeco. You agree, Connor?
I think the magic number there is 10%. So if Holdco owns more than 10% of Tradeco, it is considered a non-portfolio dividend. And provided that makes up at least 20% of Holdco's income, it will pay tax at 25% instead of the 30%.
That's right. But I guess when we're dealing with family groups, we're talking about 100% ownership here. So that will be the case.
Right. Let me just go back to the questions. So, next one, should I sell my property now before the capital gains changes come into effect? Are there any disadvantages to holding on to them? And capital gains tax being my topic, I'll just quickly cover that one. As I mentioned earlier, it's the changes to the concession for inflation that has changed. So there is no particular benefit to selling prior to those changes coming into effect. All decisions must be made on a commercial basis, and tax is a piece of the investing piece, but all considerations such as the appetite for instance, a commercial property or a particular asset class need to be taken into account.
Yeah, I think the relevant issue there, Connor, is that your gains that you make up until 1 July 27 are still going to be taxed at using the 50% discount. It's only gains that you make after 1 July 2027 that's going to be taxed under the new regime. So there is not necessarily an imperative to sell before the new regime comes into play.
Script from Daryl. When should I restructure my business group?
As I said, I mean, if we're particularly talking about the taxation of trust, this regime is not going to come in till 1 July 2028. So we've got a couple of years to think about it. However, I mean, the real issue that we all have to deal with now is that clients are acquiring property. And the question I get asked now is, how should I acquire this property on the basis that this regime may well become law? So although we've got 2 years before this regime comes into play, and we haven't seen the legislation, and we haven't seen the rollover relief that they're proposing, or the extension to the rollover relief, how do you acquire assets today? And so it may well be that these restructure conversations are going to be happening from now, from today, where property is being acquired for the future benefit of the family. You're not going to want to acquire it in a structure where, to get income into that structure, you're going to pay 70% tax. So, or at a very minimum, 60%. So these are real issues that are occurring today, and we're sort of doing it half blindfolded.
Next question, Daryl, is there any advantages to trusts anymore?
I think that there will always be a need for trusts. I think, you know, the purpose of trusts is, although the government has particularly this government has considered that the trusts are just merely a tax avoidance vehicle. Of course, they are not. I mean, they're a legitimate structure that in many cases has been put in place to protect assets. And an asset protection vehicle, and also a succession vehicle, so assets can be passed on to future generations. I think the real issue here going forward is that trusts can't be used to distribute to companies anymore. But I think there's still a real place for them to be able to distribute income, hold assets and distribute income to family members. And ultimately, there's only two ways in which you're going to hold property. For example, shares in a company. It's either going to be individually or through a trust. And depending upon the circumstances of the family group, to make a decision as to how you're going to do that. And I suspect that in the future it'll be a combination of both.
Another question, how and when should I get my properties valued? Is it worth valuing properties as opposed to just apportioning the gain? So I'll just quickly address that one. When should you get your properties valued? 30 June 2027 is our date. And how is these can be valuations that are done by a registered valuer, for instance, or if it is property with certain markets, real estate agents might be able to provide a valuation that stands up to the ATO's rigour. Just importantly, when the ATO does review one of these valuations and determine whether or not it is correct, it is sufficient, they look to the process that the valuer has gone to understand what the valuer how the valuer has got to the price that they have got to. Just a back of the envelope figure will not stand up to the ATO's rigour and review of the valuation. This is not just properties though, it is also businesses. So in terms of the requirement for all assets to be valued, we're talking about also the value of businesses. And when valuing businesses, that is a lot more complex. And that is going to be, valuers are going to be very busy trying to value all of these things and get to the right numbers prior to that date. Just checking to see if there's any other questions here.
We're nearly time up, Connor. We're 1 minute to go before one.
And there's one last one here, Daryl. How will the CGT changes impact non-residents of disposal of a property? There's actually a really good question because, as you'll be aware, CGT discount doesn't currently apply to non-residents, and due to some changes a couple of years ago. Unless you know, Daryl, I just need to double check to see if indexation would apply to non-residents. But I might need
We
to
might take that on
notice.
but my understanding is that this regime will not apply to non-residents. So the law is that discount does not apply to non-residents.
Yeah, I think that's us for today. Thank you, everyone, for joining us today.
Yeah, thanks, Connor, and thank you, everybody. I hope you got something out of this. And as I said, I imagine there'll be a lot of conversations between accountants and taxpayers over the coming weeks, months, and years as we work our way through this particular change and try and minimise the impact of this on everyone. So thank you all. See you all again soon. Thanks, Connor.
Thank you.